Hotel segment quarterly EBITDA crossed 1,000 crores for the first time, I believe, the fifth consecutive quarter of record performance as well, with revenues nearing the 3,000 crore mark as well. Puneet Chhatwal, who runs the ship, joins in right now to talk about how is the sector shaping up and what is the leader doing within that. Mr. Chhatwal, thanks so much for taking the time out and being with us. What's your put the quarter into perspective? A lot of record numbers, but I mean the PAT growth way more in terms of percentage terms versus the revenue growth. But are you happy with the quarter?
We are very pleased, Neeraj. Thank you for firstly for having me again on your channel. We are definitely pleased, and little correction. It's not the fifth, but the 15th consecutive record quarter. And the sector has been performing quite well. I think what the sector is demonstrating is something unique, that it's not cyclical as it used to be. There is a structural shift that has happened in the sector. And obviously, as you rightly said, we being the largest hospitality ecosystem player in the sector, we are benefiting from that kind of growth. And from our own point of view, we have changed the business model. And we have driven our growth and our pipeline by geography, by contract type, and by brands in such a way that we are able to hedge against any kind of headwinds that come and have come. I mean, this financial year, April started with Pahalgam, May we had Operation Sindoor, June we had the airline accident, followed by turmoil in the Middle East, then later in Bangladesh, flooding, landslides, everything happened that one could think of, but still the sector demonstrated a lot of resilience. And that's why we have also been able to demonstrate 17% growth for the first 9 months on the top line. And we are obviously very pleased with it because our base keeps getting higher and higher every quarter.
Yeah, that's true. I mean, but there is also this support that comes in from these marquee events that could be happening. The orange economy is one, but I hear that the room rates during this AI summit in Delhi are going through the roof. So maybe that also puts in a little bit of that gain. But I read a note, Mr. Chhatwal, which says that management expects low teens growth for the March quarter and beyond. Are we reaching a state wherein there is a predictability of steady state, revenue growth, operational metrics lasting for a period of time? Are we already at that stage now?
I think we did not say low teens. We said anything between 8.5 to 10% on RevPAR, but total revenue, what we said is between 12 to 14%. So I think that is quite a healthy number to get to because the base has become so high. So in a way, with very strong performance on the Taj brand, if you keep doing 8.5 to 10% on a base of 22,000 rupees, that's not bad. That's quite a good level of growth, because higher the number gets, the higher is the flow through to your profitability.
Got it. I mean, I think when I look back at least the journey in the last 5, 6, 7 years, Mr. Chhatwal, one of the key differences has been that you've become maybe asset light and maybe managing a lot more hotels. Now suddenly what I'm seeing, and maybe I'm wrong here, but what I'm seeing in the last 12 months or 18 months is a bevy of inorganic moves that you're doing. Are these properties or assets available at an attractive price for you to be doing this? And does this last well into the next 12 to 24 months or longer?
I hope it lasts much longer. So I think firstly, we had to go for a very good capital structure, especially post and during COVID when our revenues dropped to zero. That's one. Second is, as I mentioned, growth by brand. If you want to play in the mid-scale boutique properties or mid-scale mass brand, which is Ginger, then scale is critical. Otherwise, you should not be in that business. If you cannot scale to 500 hotels in the next 10 years, we should not be doing that. Similarly, if you're in a homestay, if you can't scale to minimum 1,000 to 2,000 homestay product, then that also does not make sense. So I think the moves that we have made is after 15 consecutive quarters of record performance, after eliminating debt, after sitting on good cash reserves, which we have reported around 3,900 crores of cash, that has become an enabler for us to go for inorganic moves, which are prudent and financially attractive, and also to add brands. I mean, we were able to add a new set of business in wellness segment with the acquisition of Atmantan. So I think the diversification of top line is happening through the diversification of brandscape without losing focus on our crown jewel, not just for Indian Hotels or Tata Group, but for I would say India, and that is the Taj brand, which is becoming globally also more significant. Next month we'll open in Frankfurt. We just opened 2 properties in Bhutan, and Frankfurt will be followed with a safari at the Kruger National Park in the month of May or June. So I think all in all, we are pleased with the growth that we have had and the prudent moves we have made both on the organic and inorganic front.
Mr. Chatwal, one more question, and maybe a strategy question. I'm just trying to get your view here. And maybe because the hotel industry has been so cyclical, sometimes it surprises us to the stability that has come in the recent few. But as I look at your product suite, between geographies, between business segments, between brands, and the revenue drivers as well, between revenue drivers, there seems to be this very strong effort or thought process in diversifying everything so that if something were to go wrong, the other thing makes up for it. Are you kind of pursuing that kind of strategy so that you can have steady growth, maybe lower growth than what might happen in a particular quarter here and there, but a steady growth which may last for long?
Absolutely. I don't know, my compliments for having you having guessed that so beautifully. The idea has been to remove volatility from the business so that we are less cyclical, and that's what I meant: the diversification in the brandscape, the diversification of the top line, and also when you're a 120 plus year old company, you're sitting on many iconic assets. That's where asset management becomes so interesting, that you can use all the spaces that you have and run your imagination, and with very small moves you can make some magic happen. And one of the best examples of that has been our reimagination of the Chambers, which is our private membership club, which drives almost through the new memberships, which is by invitation only, but those new memberships drive 88% margin. So that helps you in your margin protection. So when you're scaling up, a lot of these new businesses, a lot of these new initiatives, which come at a 35 to 40% a margin or higher margin, helps you to protect margin, helps you to protect your business model, and helps you to scale up using that art and science of growth.
Got it. My final question, Mr. Chatwal. This is the base case scenario, I presume. If indeed holiday tourism, business travels, maybe the orange economy and concerts and so on and so forth, all of that were to pick up much more, and because supply is constrained even now for the foreseeable future, could it happen that you might still do this low teens, or you didn't use the term low teens, but 12 to 14% revenue growth, but operational metrics and EBITDA might scale up faster if all of these things happen? Is that a possibility?
Yeah, I think very important in our investor presentation, we gave something which I'll share with you. You have to look at the growth over the last 5-7 years. So what we have given in the investor presentation is high teens growth and almost close to 17-18% EBITDA growth on a CAGR basis, not on a quarter-to-quarter basis, but a CAGR of last 3 years and 9 months we have provided. And if we look at the last 7.5 years, we have gone from 150 hotels portfolio to 600 hotels portfolio, a 4,000 crore consolidated revenue, marching and forging ahead towards 10,000 crore revenue. So I think if we don't take a quarterly view, rather a holistic view of what has happened and what is expected to happen, given the guidance that we have provided under Accelerate 2030, we are very much either in line or ahead of our guidance.